Friends, in this video for ithought Advisor, I'm going to talk to you on the topic getting your investing right. May was an extremely volatile month. June was also volatile. July is going to be volatile, but probably we could see lesser volatility. Nobody knows what will happen, but global economic events, data, and flows across countries is definitely going to impact our investing. Indian investors are already seeing a lot of red in their portfolios. Many people got into this financial year with a portfolio which was skewed more towards smaller sized companies and mid caps. Most people did not see too much merit in investing in large caps. Be it in fund investing or in a PMS, most people wanted more risk when the financial year began. But I expect that people will want to incrementally take lesser risks as the year progresses. What does this mean? It means that you started the year with a particular thought process. That thought process is set to change as the year progresses. It means that you need to change your portfolio in alignment with the change in your thought process. Your risk appetite is certainly going to go down as you experience more of this volatility. You don't want to see so much of movement in values of your investments. So you would want to move towards a lower risk space. This means you need more money to make better investments in safer companies. How could you do that? You're already invested. You don't have too much liquidity. The choice is very limited. You can only use your existing investments sensibly, correctly, and diligently to create a future portfolio somewhat different from what you're having today. For many people, this is absolutely necessary so that they get their investing right. Today, their investing is still facing a direction which does not factor in a lot of macroeconomic changes. So, you need to change the portfolio direction to align it with the emerging macroeconomic scenario. What do you need to do? First, in your portfolio, there would be some bad eggs. You need to identify the bad eggs and get rid of the bad eggs. That's the first priority. When you sell your bad eggs, you create liquidity. Many people never sell their bad eggs. They mostly sell only their winners. But the first thing somebody should do in a time like this, when the markets are rallying, is to sell their bad eggs. It's only when the markets rally that you can sell bad eggs. Otherwise, the valuation will be too low or the liquidity may be inadequate for you to even sell. So, sell your bad eggs, get rid of your bad eggs. That's the first thing you need to do. The second thing you need to do is allocate that money smartly. When you release money from bad eggs, you must allocate your money correctly in areas of the market which will help your portfolio in the future. They should give you portfolio stability and also benefit from headline economic growth. So, larger companies, more stable companies, companies which are at more reasonable valuations, companies which are temporarily out of favor with the market. These should be your focus areas. If you don't know what to buy, choose a large cap fund which is aligned towards such companies. So, 2 points have been discussed so far. I'm going to recap them. The first one is get rid of bad eggs. The second one is allocate smartly. Now, to the third point. Past performance will not help. While you make decisions on where you want to invest, don't look at what was the previous high. 52-week high and see how much a stock has fallen. That won't help. Don't look at a fund which has performed well in the past but has been trending poorly for a long time to come. In the sense, you may see a company doing very well over a 3-year or 5-year period, but it's 1 year, 6 month, 3 month, 1 month may all be showing tremendous weakness against the benchmark. If that is the case, there could be something fundamentally wrong with the investing. An investor and his ability to manage a product is best seen in volatile times like this. So if you're seeing lack of that ability, then you need to ignore that fund despite the fund having a great story of performance 3-4 years ago. Currently, he is not in good form. Don't pick an out of form batsman and hope that he will come up with a match winning score. So, past performance, especially over long periods of time, should not be the driver of your decisions. So, what should be the driver? That's our fourth point. Current portfolio merits matter. Look at the current portfolio or look at the current form of the stock you're buying. Is it looking good for the future? Has it been constructed in alignment with the emerging economic scenario? That's very important for a portfolio. That's equally important for an individual stock. So, invest on current merits, ignore past performance. So, we have more points that we have made. The first point was past performance does not matter. The second point is merits of the current portfolio matter. Invest on current merits. So, these are some of the points that you need to remember while you ensure that you get your investing right. If you do all these things, then you will make choices which are futuristic, which will perform well when the markets recover, when the economy bounces back, and which are also going to give you a runway to invest more money if the markets remain volatile longer than you anticipate. So, that choice should help you maintain conviction. It should help you manage your emotions. It should help you remain confident, and it should give you the confidence to invest when markets are wobbly and shaky. So, that in essence is what you need to do to get your investing right. And if you do these things in these volatile times, your portfolio would definitely be in a better place when the economy recovers, when inflation sobers down, when interest rates fall or stop rising, and when we see better growth. Thank you for watching this video.